Auto loans emerge as the most active consumer credit category, and early-stage delinquencies improve across all loan products. Overall, borrowing levels are plateauing. What does that mean for the consumer credit economy? Welcome to Credit Gauge Live. I'm Jeff Richardson, your host, joined as always in New York City by our lead analyst, Susan Fay, and Atif Mirza. Let's examine the trends. Atif, first question to you. Are consumers actively searching for credit this month?
No, thank you, Jeff. So we're seeing notable increase in credit originations this year. In April 2025, consumers opened up more accounts across the board compared to last year, especially in auto loan and personal loans, where we see auto loan even edging above pre-pandemic levels, 0.16% from January of 2020. Now, there are several factors for this bump. In auto loan, consumers are trying to lock in purchases before the financial volatility, such as tariffs, and also seasonal factors like tax refunds that free up cash this time of the year.
Interesting, Atif. Susan, let's talk about delinquencies. What are the trends we're seeing in delinquencies?
So overall, in April, credit delinquencies improved across all days past due categories compared to the prior month. However, they still remain elevated compared to the same period last year. And when we look at the underlying products, so this would be mortgage, credit card, auto loans, and personal loans, we're seeing that there is some improvement in late-stage delinquencies compared to April. But when we look at the early stage delinquencies, that shows a different story. So for auto loans, month over month, they have actually jumped the delinquency rate by 0.32%, and personal loans rose 0.11% compared to the prior month. We see the opposite when we look at credit cards and mortgages. So early stage credit card delinquencies actually improved 0.12% compared to April, and mortgages improved 0.1%. So what that means is that consumers have prioritized their payments to credit card and mortgages over the other credit products.
That's really interesting, Susan. Atif, over to you. Balances. Are consumers starting to pay those monthly balances down?
So yeah, in April 2025, average balances were actually flat compared to March of 2025, up only $14. So not really a big move there. However, the more interesting trend is the balance to loan ratio trend, which we see a consistent decline from the start of the year. In April, it was at 50.81%, which tells us that the consumers are prioritizing big ticket items over everyday swiping. So even with that moderation, overall balances are still sitting at 5-year high for the fourth straight month, which tells us that the consumers are not borrowing at the moment. However, they are carrying higher balances in recent years.
So some positive trends there. Thank you, Atif. Thank you, Susan, as always, for your insights on Credit Gauge Live. And up next, we've got our special guest for Credit Gauge Live this month, Mike Girard, Senior Director of Asset-Backed Securities for Fitch Ratings. Mike is one of the nation's foremost experts on the consumer credit economy, and in particular, the automobile industry. So we'll get his outlook for that industry and better understand how tariffs might impact automobile sales. Stay tuned. Welcome back to Credit Gauge Live. I am delighted to be joined by our guest this month, Mike Girard, Senior Director of Asset-Backed Securities at Fitch Ratings, which of course is one of the big three ratings agencies. Mike, thanks for joining us.
Thanks for having me, Jeff.
Let's start at high level, then we're going to drill down. How are lenders adjusting underwriting criteria in today's market?
So we haven't really heard of material underwriting changes in recent quarters from lenders and the platforms that we rate within ABS, though there's some continual tightening following the larger changes that we saw in 22 and 23. So effectively, we went through a credit cycle already coming out of the pandemic and through those years there. Overall, this aligns with the data that was released by the Fed through the recent officer survey, which showed an uptick in tightening standards by banks on auto loans by a percentage of about 2% in Q2, but still significantly below what we saw last year. And overall, when you look at the respondents, the majority of them have reported little to no changes in credit standards currently. Though if we just think about the current macro environment and potential weakening there, it's further to see some further tightening there should borrowers continue to struggle to make payments, especially if vehicle prices increase.
Yeah. So then what's the biggest risk to sort of the downstream auto ABS performance, maybe in the next 6 to 12 months?
Yeah, so it's really that economic impact from the current disruptions of global trade and the the uncertainty that comes along with the trade policies, which would lead to weaker economic growth, rising unemployment, and elevated interest rates, which would put a further strain on households, with more impact we'd expect to see on the weaker borrowers, so the lower segments there. This overall has made us make downwards revisions in our expectations for the economy this year. And even though you do have that recent announcement between China and the US, which dodged a worse outcome, the remaining tariff impact is expected to still have a material impact on the consumer. And we're already seeing that in terms of higher prices and indications that prices are going to rise further, with major businesses making statements there. So far, consumers have remained resilient, though as we expect these to be passed through, is likely going to lead to higher inflation, a squeeze on real wages, impacting their spending ability and their ability to service debt, which would lead to higher delinquencies and losses, something that we've incorporated in our 2025 asset performance outlook, both for prime and subprime loan ABS, at deteriorating, which is a year-over-year expectation. There is some positives here, though, with the used vehicle prices expected to increase. That would help contain loss severity if you just think from the recovery standpoint, as more buyers will likely shift to used vehicle prices should production levels for new drop off and prices increase.
We'd be remiss if we didn't at least talk a little bit about tariffs. What is your expectations for how proposed tariffs could impact imports and the used auto parts industry and the industry overall, even the downstream kind of ABS expectations?
Yeah, so there's a lot of uncertainty still with tariffs, especially with regards to how long they're going to be in place. They're already proving to be disruptive. If you look at the early signs already, there's been temporary plant closures, reduced shifts in plants, reallocation of some models back to the US and so forth. So assuming these tariffs remain in place, it's possible we could be in a similar situation that we found ourselves after the pandemic, where there were supply constraints resulting in lower vehicle production and availability, higher new vehicle prices, and shifting demand to used vehicles, pushing those values higher. However, unlike then, consumers now have been dealing with inflation and higher rates for some time. And there's further impacts here by a softening labor market, which would apply further stress to some and therefore impact demand. And if we look for our sales expectation for this year, just to give some perspective, we're expecting about 15 million units for the new vehicle sales in the US, which is down from 16 million from our estimate at the beginning of the year. So you can just see how much impact the tariffs would have there. But overall, we wouldn't expect the implication to be even across OEMs. There's going to be some that just are less exposed than others, given where they produce the vehicles. So some are going to have more of a competitive advantage, while others might struggle to increase the prices to cover the 25% tariffs, just so they don't pass on that full cost, which would lead to adjustments in production and likely their sales plans. So this could lead to shifts in vehicle mix, again, similar to what we saw after the pandemic. So we could see certain segments and higher trim for models be prioritized in this case in order for the automakers to absorb some of those costs, though we'd likely to see production cuts first prior to that. And now when we look at the ABS impact, you're likely to see shifts in the collateral pools overall. So likely to see higher average principal balances as prices are expected to go up, higher term as consumers stretch out the term in order to afford the more expensive vehicles. And both of these could lead to higher delinquencies and losses. And the risk increases if lenders open up their credit box here in order to maintain sales volume. So if they were to originate these longer term loans with weaker borrowers, for instance. Other impacts here, you'd likely see higher percentage of used vehicle loans, some shifts in segments and models as well, just again due to that production level and availability. But all else equal, this could potentially result in weaker collateral pools and weaker performance should macro pressures persist for the consumer.
And we'll be all over the delinquency trends on Credit Gauge Live. Mike, really appreciate these really important insights, and hopefully you'll come back and visit us again later on this year.
Thanks for having me, Jeff.
That's a wrap on this month's edition of Credit Gauge Live. For more information, you can go to VantageScore.com. And until then, we'll see you next month. Thanks for watching.